Most people think wealth is about how much you make. It is not. It is about how much you keep, how long you keep it, and whether your money works when you are not. The 7% wealth rule is simple. If you consistently invest and allow your money to compound at an average annual return of 7%, over time your wealth becomes self-sustaining. At that point, your investments grow faster than your contributions. Money starts building money. 7% does not sound dramatic, it does not feel exciting, it will not trend on social media. But over 20, 30, or 40 years, 7% quietly changes everything. Yet about 85% of people never reach the point where their investments compound meaningfully. They earn, they spend. They restart from zero, they stay busy but never build momentum. This is not because they are lazy or incapable. It is because the system rewards consumption, distractions are constant, and patience feels unnatural. Let us break this down in plain terms, what the 7% rule really means. Historically, broad stock market index funds have averaged close to 7% annual returns after inflation over long periods. Some years are up 20%, some are down 30%, but over decades, the average smooths out near that range. If you invest $10,000 at 7%, you earn $700 in the first year. That is not life-changing. But here is what most people miss. In year 2, you are not earning 7% on $10,000, you are earning it on $10,700. In year 3, it is 7% on $11,449, growth stacks on growth. After 10 years, that original $10,000 becomes about $19,671, after 20 years, about $38,697. After 30 years, about $76,123, after 40 years, roughly $149,745. That is one lump sum with no additional contributions. Now imagine you invest $500 per month for 30 years at 7%. You would contribute $180,000 over that period. Your portfolio would grow to around $566,000. Almost $386,000 of that is growth, not your direct savings. This is the shift. Once growth overtakes contribution, you cross a line. Wealth is no longer something you push uphill. It begins rolling forward on its own. That tipping point is the heart of the 7% wealth rule. Why 85% never reach it? The reasons are not mysterious, they are behavioral. 1. They never start early enough. Time is the real engine, money is just the fuel. Someone who invests $300 per month from age 25 to 35 and then stops can end up with more at retirement than someone who invests $300 per month from age 35 to 65. Why? Because the first investor gave compounding an extra 10 years to build on itself. Most people wait until they feel ready. They want a higher salary, fewer bills, more stability. But wealth does not reward perfect timing. It rewards early action. Every year you delay is not just a year lost, it is a year of compounding that will never exist. 2. They interrupt the compounding cycle. Compounding only works if it is left alone. People invest for a few years, then panic during a downturn and pull money out. Or they dip into investments for a car, a vacation, or to cover lifestyle inflation. Each interruption resets momentum. Imagine planting a tree, letting it grow for 5 years, cutting it down, and starting over. You will always have a small tree. Wealth requires letting the tree grow. 3. Lifestyle inflation eats the surplus. Income rises, so do expenses. A promotion leads to a nicer apartment, a bonus leads to a new car. Raises turn into subscriptions, travel, and upgraded habits. Nothing feels extravagant, it feels earned. But if your expenses rise at the same rate as your income, your investment rate stays flat. Without a widening gap between what you earn and what you spend, there is nothing substantial to compound. The wealthy are not always the highest earners. Often, they are the ones who lock in a reasonable lifestyle and invest the difference. 4. They chase short-term excitement. A steady 7% feels boring compared to headlines about people doubling money in months. Speculative trades, trendy assets, and market timing promise faster results. Occasionally, someone wins big, most do not. Volatility feels like opportunity, boring feels like stagnation. But consistent wealth is almost always built through discipline, not excitement. When people chase spikes, they often buy high and sell low. The average investor underperforms the market not because the market fails, but because behavior fails. 5. They underestimate how long it takes. We live in a world that compresses time. Food arrives in minutes, messages arrive instantly, streaming eliminates waiting. Compounding ignores that culture. The first decade feels slow, growth seems unimpressive, doubt creeps in. But compounding is not linear, it accelerates later. In a 30-year investing journey at 7%, a significant portion of total gains often comes in the final 10 years. The curve bends upward late, many quit before the curve turns steep. 6. They rely only on income. Most people focus almost entirely on earning more. They negotiate salaries, switch jobs, build side businesses. Increasing income is important, but income alone does not create wealth, invested income does. If your lifestyle absorbs everything you earn, your net worth stalls regardless of your salary. Wealth comes from converting income into assets that produce more income. 7. They avoid learning basic financial principles. Many people graduate without understanding compound interest, asset allocation, or inflation. Money feels complex, so it is avoided. Avoidance leads to inaction. Inaction leads to lost time. Lost time is the most expensive mistake. You do not need to become a market expert, but you need to understand enough to act with confidence. The mathematics of patience, the reason 7% works is not magic, it is multiplication over time. If you double your money once, that is good. If you double it twice, that is powerful. If you double it 5 times, that is transformation. At 7%, money roughly doubles every 10 years. So $50,000 becomes about $100,000 in 10 years, then $200,000 in 20 years, then $400,000 in 30 years. That third doubling feels very different from the first. But you cannot skip to doubling number 3, you must endure the early stages when progress seems small. This is where most people fall off, the psychological barrier. The real barrier is not math, it is emotion. Fear during downturns, impatience during flat markets, envy when others appear to get rich faster. Imagine investing steadily for 15 years and then watching the market drop 25% in 1 year. On paper, years of gains shrink, panic feels rational. But historically, markets have recovered and continued upward over long time horizons. The investor who stays invested often benefits from the rebound. The one who exits locks in losses and misses recovery. Compounding requires emotional stability more than financial genius. The 7% rule in practice, reaching meaningful compounding requires 3 practical steps. 1. Save at a rate that matters. If you invest 2% of your income, progress will be slow. Many financial planners suggest aiming for 15% to 25% of income invested consistently over a career. That level creates real momentum. If that sounds high, start lower and increase annually. Even 1% more each year changes the trajectory. The key is automation. When investments happen automatically, discipline is no longer a daily decision. 2. Choose broad, low-cost investments. Fees eat compounding. A difference of 1% in annual fees may sound small, but over 30 years it can reduce your final balance dramatically. Broad index funds with low expense ratios allow you to capture market growth without heavy drag. Simplicity wins. 3. Commit to decades, not months. Your time horizon must match the strategy. Money needed next year should not be in volatile investments. But money meant for 20 or 30 years from now can ride out turbulence. The longer your horizon, the more reliable the average return becomes. When the shift happens, there is a moment when your annual investment growth equals or exceeds what you personally contribute. For example, if you invest $20,000 per year and your portfolio grows by $22,000 in a year without extra effort, something has changed. Your money is now working as hard as you are. From that point forward, every year of consistency widens the gap between effort and reward. This is when people begin to feel financial breathing room. They may not be ultra wealthy, but they are no longer starting from zero. Why income alone rarely solves it? Consider 2 people. Person A earns $60,000 per year and invests $10,000 annually. Person B earns $150,000 per year and invests $5,000 annually. Over decades, Person A often builds more wealth despite earning less. Wealth is driven by the gap, not the headline number. High income with low investment discipline creates a fragile financial life. Moderate income with high consistency creates resilience. The cost of delay: suppose you plan to invest $500 per month starting at age 25. If you delay until 35, you lose 10 years of compounding. At 7%, that delay can cost hundreds of thousands of dollars by retirement. The lost decade is expensive not because of missed contributions alone, but because of missed growth on growth. Time magnifies small differences. Why 7% is realistic but not guaranteed. Markets do not promise 7% each year, returns vary. Some decades outperform, some underperform. The rule works when you think in long windows and maintain diversification. It fails when expectations are short-term or concentrated in one bet. The purpose of the 7% wealth rule is not to predict exact outcomes. It is to anchor expectations around discipline, long-term investing rather than speculation. The hidden advantage of consistency reduces decision fatigue. If every market movement triggers a new plan, stress increases and mistakes follow. The tragedy is not that wealth is impossible, it is that it is possible but requires traits that feel uncomfortable in a fast world. Patience, restraint, boredom tolerance. These are not flashy skills, but they are profitable, building toward financial independence. At some point, if your portfolio grows large enough, a 7% average return can cover a meaningful portion of your living expenses. If you need $70,000 per year to live and you have $1 million invested, a 7% return equals $70,000 before taxes and market variability. In reality, prudent withdrawal strategies are often more conservative. But the principle remains: a large enough invested base can produce income without selling your time. If this video helped you see money differently, share it with someone who needs to hear it. Wealth isn't built overnight, but the right mindset can change everything. Don't forget to like, subscribe, and turn on the notification bell so you never miss the next video. More practical insights coming your way.